Hey everyone, welcome to Bald Guy Money. I am Bald Guy, and after we had a little panic in the precious metals market, and some of you giving me grief in the comments section of my videos saying gold had topped out at $2,400 an ounce and that silver was on its way down to $20 an ounce, here we are just 2 weeks later, and we've gotten a nice bounce in prices. Gold really didn't come down that much, to be fair, but it has made a new nominal all-time high at $2,507 an ounce, and silver, which pulled back and kissed off of the 200-day moving average around $26.50, has bounced right back up to close at $29 an ounce this past week, keeping both silver and gold's outperformance of the S&P 500 index in 2024 intact, as you can see right here on the screen. Now, as I assume most of you know already, Friday's big increase in gold and silver prices was driven by something that was inevitable: China's return as a major buyer of gold, as several Chinese banks received import quotas from the Chinese central bank, which claims that despite record high prices, they expect demand for gold to start increasing again after a 2-month slowdown. Now, if that's because they know something about a potential military action or maybe even something associated with the stability of the global financial system, I can't say in this video. But it is interesting that it is happening right around the same time that Warren Buffett's Berkshire Hathaway has built up a record cash pile of nearly $300 billion, most of which is sitting in treasury bills, or in simpler terms, short-term US bonds. Now, who has picked the better safe haven? Is it Warren Buffett or is it the Chinese? Only time will tell. But with interest rates on short-term bonds and even certificates of deposit around 4.5% to 5%, and US inflation estimated to be at around 2.9% in the latest reading, if we take that number at face value for the sake of argument, bonds aren't really looking that bad these days, and it seems like a decent place to park some money without having to take too much risk or participate in the market volatility that has turned investors fearful as we wait for everything to come crashing down. So, considering the fact that I am in both bonds and certificates of deposit right now with a sizable cash position that I've built up for myself as of late, I think it's time to address an obvious question, one that I never see other YouTubers talk about, and that is, what is the best safe haven right now? Or at least, what is the better safe haven right now? Is it bonds? Is it precious metals? Or should you just keep plugging away in the S&P 500? So, for that reason, in this video, I want to dig into that topic by comparing them head to head, by giving you a full breakdown of what these investments have the potential to return to you, and we will be looking at data going all the way back to the year 2000 to give you a fuller picture of how each of these has performed in terms of wealth and savings growth, as well as factoring in risk as an additional consideration. Once we've covered that, I want to use the model I've put together and plug in some of my price projections to get an idea of where this market might be going and explain why I have chosen to allocate some cash to bonds instead of going all in on precious metals. And to round it all off, I'm going to give you all my latest outlook on platinum, as so many of you have requested. So, without wasting any time, I want to start here by taking a quick look at cash returns on bonds and certificates of deposit. Now, with interest rates as high as they are today compared to the last 15 years or so, it's hard to make an argument that this has been a great savings mechanism. Just ask any bank that is sitting on huge unrealized losses on their bond positions right now. They'll tell you the exact same thing. They really haven't been worth the trouble. But in this exercise, and this will apply also for gold and silver and the S&P 500, I just want to assume that we take $200 a month, so $2,400 a year, and put that money into the place we think it's safe and will deliver the best return. So, since 2000, the average cash saver who has put money into bonds or certificates of deposit has probably been able to get somewhere between 1.5% and 3% on average as an annual return. Meaning, if we take the US Bureau of Labor Statistics number of 86% inflation from January 2000 to today, which I know it's definitely higher than that, but again, for the sake of argument, let's use this number, please. That level of return that you've gotten on that 1.5 or 3% return has made you a loser in real inflation adjusted terms. And it's not until you start getting into the area of a 5% annual return on your cash, which is more or less in line with what you can get on your cash right now, that the return becomes net positive, as 5% a year compounded since 2000 has yielded a total return of 91%. So being generous to bonds and CDs, CD is just a short way of saying certificate of deposit, being generous to those two things, I am going to compare the 5% annual return to what we could get on my favorite safe haven asset, and that's precious metals. So here are the figures of how 5% a year on bonds or a CD stacks up against precious metals. And what I've done here is I've taken that $200 a month we've theoretically invested since 2000 and purchased the average price of silver and gold with it for that calendar year. On top of that, I have assumed a flat 10% premium on both the gold and silver that we've purchased to make the comparison fair, because so many of you always say that I don't take those premiums into account. We are taking premiums into account here. And then once we've calculated the amount of gold and silver you would have purchased with that money for the year, at the bottom of the screen there, you can see I have multiplied the total amount of silver and gold purchased over those 25 years by the current spot price, so $29 for silver and $2,506.84 per ounce of gold, to calculate the value of those purchases today. And as you will immediately see, the big loser, silver, the metal every internet troll loves to hate, has yielded an objective return, including that 10% premium, of 128% over this period, beating both official inflation, which was 86%, and our high-yielding bonds and CDs, which have given us a modest 91% return over that same period. So as much as I understand the frustration that is associated with the topic of silver, especially for those of you who entered the market at $40 or $50 an ounce back in 2011, looking at these numbers, this is the objective reason why I still buy silver on a schedule today, and it's because I know that being on that schedule, while obviously trying to target the pullbacks over long periods of time, and believe me, I still intend on living for a little while longer, will reward me over those longer periods of time in a similar way that it has rewarded me with gold, which if you had gotten on a schedule in 2000 with only $200 a month, buying at a 10% premium again above spot, that gold today would be worth $182,344 in total after you put your $60,000 total into it, meaning that your return on your investment on the money you would have put into it would be more than 200% today. So now that we've firmly established that metals, when using this scheduled purchasing method of $200 a month, so not looking at two random points in time to support a biased argument either for or against metals, which I see too often on YouTube, since we've established that using that method has yielded better returns for both gold and silver versus bonds and CDs yielding a generous 5% return per year, it's time to look at how they stack up versus the S&P 500. And I'm sure a lot of you are saying, but the S&P 500 isn't really a safe haven, and I think arguments can be made both ways on this because it has been a steady performer and source of great returns since 2000, and for that reason, I think putting some money into the S&P 500 as let's say, a growth safety play makes perfect sense as a long-term investment strategy. Because as you can see here, using our $200 a month over the last 25 years, and assuming a 1.5% transaction fee when purchasing the stocks, I think that level is fair. The total $60,000 invested over that period of time would be more than $200,000 today, yielding a total return of 237%. And despite amazing performance for gold over that same 25-year time period, you can see that the S&P 500 has done slightly better. Let's not close our eyes to this fact. But as I've been saying for the past few weeks, I expect things to change a bit over the coming 2 years. And I've shared some price projections for 2025 and 2026 as they relate to the S&P 500, silver, and gold in some recent videos. And what I did here is I took the 2025 numbers for gold and silver and I plugged them here into this table to prove a point. Because many of you watching probably think $45 silver and $3,000 gold are a possibility in 2025. And if not in 2025, let's conservatively say 2026 while leaving the $1,000 per ounce silver estimates on the shelf for now. In addition to that, I think that many of you watching expect the S&P 500 to either go down, which is the scenario that I'm expecting, or at least to stagnate around these levels in what we'll call the best case scenario. So let's assume the best case scenario for the S&P 500 and those conservative price targets for gold and silver. And as you can see here, if the S&P 500 stays where it's at, which is, in my opinion, a very generous assumption, not only will the value of the gold purchased in our scenario since 2000 go past, so perform better than the S&P 500 over that same time period by yielding a 264% return versus the 237% return that we're seeing for the S&P 500 index today over that period of time. But silver, yes, silver at $45 an ounce reaches a return of 254% over that period of time, also beating the S&P 500, and that includes the 10% premium above spot. So obviously this is a little bit of fun with forecasting, but it is my opinion that a similar scenario to this one will play out over the next couple years. Now, it doesn't mean you should go out and go all in on one thing, because I think all three of these things play an important role in a responsibly built portfolio, and you don't have to take my word for it, but you can give some consideration to the fact that I retired before 40 with the help of scheduled purchases of all three of these assets, as well as real estate. And to circle back to why I'm keeping money in bonds and CDs right now, the answer to that question is simple. I'm not going to keep the cash just in a bank account, because that would be stupid. I would be losing money versus inflation, and that's something that I'm not willing to accept. But keeping it in a bond and a CD at the current rates of interest are actually not that bad considering the direction inflation is going in. And I'm not trying to downplay inflation at all. I understand that it's still too high. Prices are still going up, but it is objectively today lower than the return that I'm getting on my bonds and CDs. So I have parked some money there in order to take advantage of some of the volatility that I see coming around the corner, whether that's going to be in stocks, real estates, or taking advantage of a short-term flash crash in precious metals as well as mining stocks. That remains to be seen, but I have the flexibility to do that with that cash position, and it's why I'm holding bonds and CDs today. Okay, so now it's time to move on to a topic that many of you requested in the comments section of my video from 2 weeks ago, and that is my take on platinum. Is it a real bargain at today's prices, or is it what they call a value trap in the world of finance? So let's start from year-to-date performance for platinum versus silver and gold, and here it is for you all to take a look at. And as you can clearly see, platinum is the only one of these metals that is down so far in 2024, and there are basically two ways you can look at this. The first way is to say platinum is currently underinvested versus gold and silver, which means at some point there should be a rapid rise in the price of platinum as it moves to catch up to the great performance that we've seen on gold and silver, and potentially platinum could once again become more expensive than gold, which was quite normal up until about 2015. Now, the other way to look at it is you could say something has clearly changed for platinum over the last few years that has resulted in price stagnation, and it could result in more poor performance for platinum moving forward. So let's switch over to the 5-year charts, and I think these charts give us a much better indication of what the truth is when it comes to platinum. Because as you can see here, this isn't just some slow 2024 performance for platinum. This underperformance versus gold and silver is a longer-term trend. And although some people, including my friend Rick Rule, say that depressed platinum prices since 2022 could be a result of Russian platinum dumping as they try to fund their war with Ukraine. Russia, by the way, is the world's second largest supplier of platinum, and they mine about 12% of the world's annual supply. Anyhow, the way I see it, the numbers and charts don't support that Russian dumping explanation. Because yes, platinum took a little bit of a tumble in the early days of the war, and I've marked that February 2022 date on the chart there for you to see. But the price has remained in a tight trading range that I've marked in those black lines since 2015, which covers a period after the invasion of Crimea and well before the current war they have going on with Ukraine. But as I always say, charting and price trends are not everything because fundamentals are very important. And it's why I've been so consistent in saying that silver is undervalued ever since I started this channel back in 2021. Because the fundamentals for silver, looking at physical supply and physical demand, support arguments for higher prices in ways they simply don't support them for platinum. Now, I've pulled up two charts here. Apologies for how they're situated on the screen here. It was the only way I could fit them both in. And the vertical chart on the left shows supply of platinum, and the large horizontal chart on the right shows demand for platinum. And this is where platinum bulls really see opportunity, because they say, okay, platinum demand is admittedly flat. It's not going up as it is in the case of silver. And that could be because demand for catalytic converters in automobiles, which is roughly 50% of platinum demand, is going down. Less platinum is needed to produce a catalytic converter today as technologies get better. And maybe it has something to do with electric vehicles gaining shares versus internal combustion engines. But no matter what the reason is, while demand for platinum is flat, supply is shrinking, and we are unable to meet the current annual demand for platinum, which, and this is the classic argument that silver bulls use, including myself, means that at some point, once the surplus of platinum is used up, will result in a shortage, pushing the price of platinum up, and it's a good assumption until you realize that the supply numbers covered here on this chart cover only new supply. Because with platinum's price being much, much higher than the price of silver, there is a huge incentive for the metal to be recycled. And it's precisely why you can get your catalytic converter stolen if you park your car in the wrong neighborhood at night. And if we take a look at platinum recycling figures, if you take a close look at this data, and remember, I always leave the links to my data sources in the description of every video. You can find them below, so you can take a look at this data yourself if you don't believe me. You will see that recycling tracks very well with overall demand. And with so much of used platinum concentrated in one place, where it's pretty easy to get it from, that being catalytic converters, it makes the platinum recycling business much easier and much more profitable than the silver recycling business. So when you pair that fact with stagnating demand, it doesn't make me very optimistic for a big move up on platinum price built on fundamentals, especially when alternatives to platinum in industrial use, like palladium, and this is a 5-year price chart of palladium here, remain available and increasingly affordable to use when compared to platinum. So yes, platinum was at one point in time more valuable than gold, and there are many people out there buying platinum today, physical platinum, expecting that same thing to happen once again. And all I can say about that is that in 2008, when we had the global financial crisis and it brought central banks back into the gold buying game, from my point of view, it caused a shift in the market. And I don't think it's one that's going to reverse for how the price of gold relates to the gold of platinum, in that I think that gold is going to remain more valuable than platinum moving forward, unless we find some amazing use for platinum that consumes much more than we're using today. And I'm sorry for those of you typing hydrogen cars in the comments section right now. In my opinion, that's just not it. Now, to make matters worse, and I'm really going to give my unfiltered view on platinum right now, the metal itself as a physical investment or a store of value is just awful. In fact, the last time I saw platinum at a coin shop, this is when I still lived in Dubai, I was talking to the dealer in the shop. He was an Indian guy from South Africa, so shout out to all my Indian South Africans watching out there. He was a really honest guy. I'd been doing business with him for a long time, and he said to me this. He said, listen, I will sell you that platinum coin if you want to buy it. But if you come back here and want to sell it back to me, I'm not going to buy that coin. And that's the sad reality that many platinum buyers end up meeting at some point when they try to get out of it. It's either that, by the way, or when they go to the coin shop and they actually find a dealer that will buy the platinum from them, very often the offer they're getting is 20% or more below the spot price, simply because that's a lot of money that the dealer has to freeze into a coin that may or may not sell, and it certainly won't sell very quickly, which is something that a coin shop is really relying on. It's relying on turnover, and it's relying on cash flow. So these are the reasons why I don't buy platinum. I don't think it's a good deal, and if you own platinum, all I can say is that for you is that I hope that I'm wrong, because I'm not cheering against you. This isn't one of those things where I'm like, yeah, win for me, because I've been saying, by the way, for many years that I don't like platinum, and the price charts have proven that I was right, that silver and gold would outperform platinum as I said it would, and it has. But again, I'm not trying to tally points here on YouTube, and I'm not cheering against you. I'm cheering for you. This is just my honest, unfiltered opinion as it relates to platinum and why I don't buy it. So with that said, that's it for this video. I want to thank you all for taking the time to tune into me here on a Sunday or whatever day it is you're watching me. If you enjoyed this content, please leave a like, leave a comment or a question. I may answer your question in a future video. You never know. And if you really thought this content was valuable, please share it with other people if you think they need to hear this message. So, as I end all my videos by saying, I want to say, take care of yourselves and take care of each other, everyone. See you in the next one. Goodbye.